Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, March 20th, and the markets are doing that thing where they hear inflation and immediately drop everything, including your portfolio's mood.
I love how markets are forward-looking, but also emotionally fragile. One oil headline, and suddenly everyone's a macro strategist with a stretch rash.
Three stories today: the Fed and inflation fears tied to the Middle East, Supermicro plunging after a chip smuggling case tied to Nvidia, and OpenAI's online shopping attempt stumbling. What that means for the next wave of AI commerce.
Okay, start with the Fed. Are we cutting rates, hiking rates, or just spinning in a chair until my mortgage rate cries uncle?
Here's what happened. A New York Times report says Fed Governor Christopher Waller urged caution on rate cuts as the Iran war drags on. Separately, Bloomberg's Real Yield segment quoted that bond traders boosted bets on a Fed hike by October to 50% as inflation worries rise with the conflict.
So, translation, we might cut later, unless we don't. That's not guidance. That's a horoscope with a PhD.
The simple finance behind it: think of interest rates like gravity. When traders think gravity might get stronger, higher rates, prices of long-duration assets like growth stocks and long bonds tend to fall because future cash flows get discounted harder.
So my tech stocks are basically doing pull-ups with ankle weights. Cool. Love this for me.
And the oil channel matters because energy can feed inflation fast. Transport, plastics, shipping, everything. If markets believe oil stays elevated, they start pricing sticky inflation, which pressures central banks to stay hawkish longer.
But hold on. People always say higher oil equals recession. Doesn't that mean the Fed should cut, not hike? Pick a struggle, Jerome's extended family.
That's the tension. Oil can slow growth and push prices up at the same time. If inflation expectations jump, the Fed worries about credibility. Waller's caution is basically, don't declare victory on inflation just because you want cheaper credit.
I disagree. If the labor market weakens, households don't care about credibility. They care about jobs. You can't lecture inflation down while people are getting laid off.
Fair pushback. But here's the reversal. If the Fed cuts too early and inflation reaccelerates, real wages get hit and borrowing costs can rise anyway because investors demand higher yields. So protect jobs now can backfire into hurt jobs later.
Okay, I'll concede that. It's like trying to fix a kitchen fire by turning on every stove to fight heat with heat. You might win by deleting the kitchen.
Story 2. CNBC reports Supermicro shares tanked 25% after employees were charged with smuggling Nvidia chips to China. The backdrop is U.S. efforts to crack down on illegal shipments of top-tier AI chips.
A 25% drop is not a dip. That's a trapdoor. So what's the finance lesson? Don't let your supply chain cosplay as Fast and Furious.
The simple version: markets price not just earnings, but the reliability of those earnings. If regulators tighten enforcement, a company tied to restricted components can face disrupted sales, compliance costs, customer hesitation, and headline risk. So the E in PE suddenly looks shakier.
So investors are paying for certainty, and the minute the story becomes federal charges, certainty evaporates. Honestly relatable. If my dentist got indicted, I'd reschedule too.
Why it matters for normal people. If you own broad index funds, you're exposed to AI infrastructure names indirectly. And if you work in tech, export controls can change hiring and budgets, because when hardware access is constrained, projects slip and spending priorities shift.
Actionable takeaway? If you're AI all in, maybe check concentration. Like, don't let one theme become your entire personality and your entire portfolio.
Story 3. CNBC says OpenAI's first crack at online shopping stumbled. Partners like Etsy, Walmart, and Shopify moved quickly, but item information was often inaccurate and onboarding merchants was difficult. They're preparing for the next wave.
So the AI agent tried to shop and got the specs wrong? That's not instant checkout. That's instant regret.
The finance behind it. Commerce is an accuracy business. If an agent is wrong even a small percentage of the time, returns and support costs explode. That makes unit economics ugly unless the system gets very reliable or merchants price in the error rate.
And the onboarding thing is huge. Everyone wants AI sales, but nobody wants to clean their product catalog. It's like saying you want abs but refusing to eat vegetables.
Why it matters for listeners. If you run a side hustle or small business, the opportunity is real. Agents could lower customer acquisition friction. But the defensive move is also real. Tighten your product data, policies, and dispute handling, because AI-driven orders can increase edge cases.
Actionable for regular shoppers too. If you use AI to buy stuff, start with low-stakes items. Don't let a robot freestyle your medical supplies or your kid's birthday cake.
Quick recap. The Fed is signaling patience on cuts, while oil-linked inflation fears push yields up. AI hardware supply chains are facing enforcement and headline shocks. And AI shopping is promising, but brutally dependent on data quality and accuracy.
Your tiny checklist for today. 1. Check your rate sensitivity, like long bonds and high multiple stocks. 2. Check your AI concentration. 3. If you're building or selling online, fix your product data before the agents arrive, like hungry raccoons.
If this helped, subscribe for the next briefing and drop a comment. Are you positioning for higher for longer rates, or do you think growth cracks first and forces cuts? We'll read the best takes.
And if your investing plan is currently Vibes, please upgrade to Vibes plus a spreadsheet. See you next episode.